I think this summer you're going to see gold have a very nice run from 3,400 area up to that 4,000 area. Silver is around 36 right now. I think I've got a target of 75 that I think we could reach by the end of this year. So silver should do. I think silver will outpace gold. Both will do well, but that's what typically happens when you really get going in a bull market in the metals. Is silver takes the lead, and it hasn't been the leader, but I think you're starting to see signs that it's going to be the leader. Both, like I said, it doesn't mean gold's going to do poorly. Gold's going to do very well.
Gold maintains its impressive momentum as Wall Street analysts increasingly project a move toward the $4,000 mark, with current market trends providing strong support for such bullish forecasts. The precious metal rose 0.1% to $3,354 on Wednesday, marking gains in 5 of the past 6 trading sessions and demonstrating the sustained strength that has characterized its recent performance. Macro strategist David Hunter, known for his bold and contrarian market forecasts, has been particularly optimistic about the trajectory of gold. Hunter notes that the metal's previous surge to the $3,400 to $3,500 range was followed by a period of consolidation that should not be interpreted as weakness. Instead, he views this consolidation phase as a strategic setup for another significant upward move, with his target of $4,000 likely to be achieved within the current year. Multiple factors, including key developments in Washington and sustained demand from central banks worldwide, are driving the rally in gold prices. Silver is also capturing significant attention from analysts and traders alike. Currently trading around $36, the white metal has attracted some selling pressure near the $36.55 $36.60 region during Thursday's Asian session, eroding part of the previous day's substantial gains to the top end of its weekly range. Despite this minor pullback, Hunter remains exceptionally bullish on silver's prospects, projecting a potential climb to $75 by year-end. The silver market presents particularly compelling upside potential when viewed through a historical lens. Trading still below $40 an ounce, silver remains far from its inflation-adjusted historical peaks. To match its 1980 high in real terms, silver would need to reach $75 per ounce, while reflecting the strength demonstrated in 2011 would require prices approaching nearly $100. Highlighting the significant room for appreciation that exists. Hunter's analysis suggests that while both precious metals are expected to perform well, silver is likely to outpace gold's returns. This expectation aligns with typical patterns observed in strong bull markets, where silver often assumes the leadership role and delivers superior percentage gains compared to its golden counterpart. Before we begin, don't forget to like, share, and subscribe. 97.4% of viewers haven't subscribed. Be part of the 2.6% who have by hitting that button now.
I think metals have obviously silver took a while to get going, but silver is even running now, and gold looks great. Gold had that run to 3,500 back a month or two ago, and it's been kind of consolidating that for a little while here, and people may be kind of wondering if gold's had its move, but I don't think so at all. I think that consolidation just kind of giving it another fresh start here, and as you said, I'm looking for 4,000 this year. I think this summer you're going to see gold have a very nice run from 3,400 area up to that 4,000 area. Silver is around 36 right now. I think I've got a target of 75 that I think we could reach by the end of this year. So silver should do. I think silver will outpace gold. Both will do well, but that's what typically happens when you really get going in a bull market in the metals. Is silver takes the lead, and it hasn't been the leader, but I think you're starting to see signs that it's going to be the leader. Both, like I said, it doesn't mean gold's going to do poorly. Gold's going to do very well too. And the miners, which have been frustrating for some investors until lately, I think those are going to continue to do very well as they have recently. So that there's going to be pauses. These things don't go straight up. There's going to be times when they get overbought to kind of take a breather. Some of those breathers are high level consolidations. Others you can get hit quickly in a bigger sell off and then come back again quickly. So it's hard to know exactly the path it'll take. But I think the miners look really good here. I would say the biggest message is probably two messages, all connected messages. One One is there's a lot of chatter out there trying to talk you out of your stocks, telling you that it's pretty fully valued and that, you should be cautious here. I would say ignore that noise, ignore that chatter, and recognize that there's a big runway still ahead. But the second message kind of goes with that. It's not contradictory to that, but it goes with it. And that is that we aren't that far from the other side of the mountain. So don't get caught up in the psychology that I think is going to come with this run. As I always tell people, the majority of investors are most bullish at the top and most bearish at the bottom. We're approaching a top. So you're going to have a lot of people on Wall Street telling you this thing has legs, that it's going to run for years, that, they're not there now. They're skeptical still, but in the next 3 months, you watch how quickly they flip around and they're going to talk, because the Fed's going to be on board. The Fed's going to be easing. Rates are going to be coming down. Earnings are going to look okay. And you're going to have investors telling you, with the Fed just starting to ease, that there's a good, long runway ahead. That's when you have to start getting nervous. When everybody is all in, that's when you want to start taking some pieces off the board. When everybody's all out is when you want to get in. It's the hardest thing to do. Just like if you go back to the April bottom, it was hard to be a buyer at the bottom because everybody was telling you things were going to get dire. At the top, it's going to be hard to say, I'm going to let it go, because you're going to watch some big moves come in your stocks. You're going to say, I'm making money. Why should I stop it? Maybe I'll wait and see. And nobody's going to get it exactly right. So I would just caution people, don't get caught up in the noise, because all that chatter is going to be bull.
The S&P 500 surged past the 6,000 milestone, driven by stronger than expected jobs data and easing tensions between Trump and Musk, with the index now trading around 6,200. Macro strategist David Hunter accurately projected a 4 to 5% rise in the S&P 500 from 5,850, followed by a retest, an outlook validated as the index reached around 6,200. He now sees further upside to 6,400 or slightly higher before any significant pullback, reflecting the market's steady, methodical advance. Hunter expects market strength to persist through July and potentially into August, with only shallow corrections expected to disrupt the broader uptrend. His analysis suggests the current momentum remains intact despite the significant gains already achieved. Looking at the broader technical picture, long-term projections for the S&P 500 remain constructive. The baseline scenario anticipates a significant surge to the 6,450 to 6,870 range over the next 12 months, representing substantial upside potential from current levels. This ambitious target reflects the underlying strength of corporate earnings, economic fundamentals, and continued investor appetite for risk assets. Let's get back to the video.
As I've been saying for a while, we're in the final leg of a 43-year secular bull market. I think this final leg is going to be pretty exciting, pretty steep. We could by Labor Day, or certainly by sometime in the fall, make a top. And that top at this point, as you said, I've raised targets, so I'm at 8,000 on the S&P, 27,000 on the Nasdaq, 55,000 on the Dow, and 3,300 on the Russell. If anything, I'm going to be raising those targets. I don't think they're going to fall short of those targets. So I think there's a pretty good sized runway still ahead of us and directly ahead of us. You can get short-term pullbacks, but I don't think you're going to see anything of certainly not the magnitude of what we saw in early April, and probably not even half of that. So, you can get a 4 or 5% pullback at any time. In recent weeks, I've been saying, and that was when the S&P was down at 58, 50, somewhere down there. I was saying, it looks to me like we probably pushed through the old highs by 4 or 5% and then come back and retest those old highs. So, that means you still got room up. The S&P right now is 6,200. You might see it run to 6,400 or a little higher and then pull back. So that's what I think we're in for, is those kind of pullbacks, not anything major. And basically, I think a strong July, maybe a strong August, we'll see. Forecast for a long time has been that we would see the market rise while the economy was moving into recession. So this is exactly what, it was a playbook I called. And I think people do not understand that slowing economy means lower interest rates, means Fed coming on board and wind at the back. because the Fed is easing. All that's coming. The dollar's down. That's helping certainly in some areas. So I just think people have misunderstood how markets work and have continually fought this. Now, at some point, the economy in my forecast gets very rocky. In fact, we move towards a global bust. The market's not going to go up in that. But for the next few months, I think the narrative is going to be soft landing. Lower rates, lower dollar. Earnings still being held intact, quarterly earnings still looking pretty good. And so you get kind of your cake and eat it too. P multiples can go up on solid earnings, and people can still remain pretty sanguine about the economy. As we move towards later in the year, into later in the fall and winter, the economy could really start getting a lot weaker. And it's at that point that I think maybe, equity investors are going to have to worry about, the fact that earnings could roll over and get hit pretty hard.
Gold continues to build strength amid supportive macro conditions, while silver, still trading far below its inflation-adjusted highs, shows even greater upside potential. As momentum builds in both metals, silver appears poised to outpace gold in percentage gains, an expected pattern in strong bull markets. With gold targeting new highs and silver gaining leadership, the stage is set for a powerful advance in the precious metals sector. Will silver's historical tendency to outperform gold in bull markets play out again as both metals gain momentum? Share your thoughts in the comments. If you found this video helpful, give it a like, share it with others, and don't forget to subscribe. Only 2.6% have, so hit that button and turn on the bell for more insights on gold and silver.